Hello, good afternoon, everyone. My name is Ron from International Trade Council, and I will be your moderator for today's webinar. The title is Duty Drawback 101 Receiving Refunds on Import Duties. This webinar will cover the following topics: an overview of the primary statutory and regulatory provision of the Duty Drawback Tax Refund Program, how the Trade Facilitation and Enforcement Act of 2015 fundamentally changed the drawback regime, creating a new opportunity. Also, understanding the process of implementing a drawback program and maximizing drawback recovery and maintaining regulatory compliance. Our speaker for today is Mr. Anthony Nogueras, CEO of Alliance Drawback Services. Before we start, just a few reminder. If you have any questions about the presentation, please feel free to type in the questions on the comment section part of the screen, and then our speaker will going to answer the questions right after. Before we start, I just want to make a quick audio check. So for those people who are currently logged in, can you please type in yes on the comment section just to make sure that the audio is clear. All right, thank you guys. All right, so since the audio is clear, without any further ado, I'm going to pass the stage to the presenter so he can start the presentation. Go ahead, sir.
Okay, thanks so much for the introduction. So once again, my name is Tony Nogueras. I'm with a company by the name of Alliance Drawback Services. I've been a drawback specialist now for 25 years. This is a specialized area, the trade compliance industry. And I'm often asked, gosh, how did you get into such a niche, specialized service? And I always say with a straight face, ever since I was a young child, my dream was to become a drawback specialist. So we're living the dream here. Anyway, we're broadcasting live to you today from downtown St. Petersburg, Florida, where it's about 81 degrees in spring break. So this is when we get to do our victory lap. Anyhow, as Rod said, the topic of today's presentation is duty drawback refunds. Drawback is one of numerous tariff mitigation strategies that are available to companies that import and export from the United States. There are competing strategies like foreign trade zones and bonded warehouses. Now, any type of trade mitigation strategy has become particularly relevant and topical since the inception of the Section 301 China tariffs. That's when the Trump administration back in 2018, in a series of actions, placed a variety of products over 4 lists and made these specific carbonized tariff schedule numbers subject to an additional 25% tariff on top of the normal rate of duty. To say that was disruptive in the marketplace would be an understatement. I know in my 25 to 30 years in the industry, it's probably the most disruptive action that's ever been taken, in the area of duties and protectionism and so forth. And of course, companies were scrambling for ways to mitigate the costs of those tariffs. The average duty rate in the United States is probably 2 to 5%. So, since that action was taken in 2018, those of us in the tariff mitigation business, this would be our proverbial 15 minutes of fame. So with that introduction, let me get into specifically how drawback works, provide you with an overview of the regulatory structure and some of the key concepts so that you fully understand the opportunity of drawback. And then we're going to discuss process. What are the process steps from the initial assessment of a potential program through some of the data elements that are required and all the way through the submission of a drawback claim and receipt of a drawback refund from Customs and Border Protection. All right, so the basic drawback law has been around for quite some time. And for the most part, there have been some notable changes to the drawback law. It's found in United States Code, part of the Tariff Act, originally passed as the second law passed by the first U.S. Congress in 1789. For the most part, we've had relatively significant but relatively minor changes over the years to the drawback statute. That all changed in 2015, where a piece of legislation that had been in the works for quite some time, that's the Trade Facilitation Enforcement Act, which was an omnibus trade bill, but it included a very significant rewrite of numerous provisions of the duty drawback law. And for the most part, it was positive. It's, any legislative change generally has winners and losers. It was a mixed bag, but for the most part, it provided more opportunity for duty drawback claimants by significantly liberalizing certain provisions of the law. In terms of industries that take advantage of duty drawback, well, let me just start with a working definition. Drawback allows for the refund duties, tariffs, and fees that were paid upon importation of the merchandise, assuming that the merchandise is at some point in the future re-exported. Now, I'm going to talk about methodologies that we can use to match imports and exports, but that's a quick and very basic definition. There are provisions that allow us to match what we call substituted merchandise so that you don't actually have to export the exact merchandise that you imported. So we're going to discuss types of drawback, primary categories, and exactly how we go about matching imports and exports in order to create a drawback claim. In terms of some of the industries here, retail, electronics, the U.S. is a distribution point for the Americas, so you see quite a bit of retail goods coming in from China and the Far East and being re-exported to the Caribbean, Latin America. Petroleum and petrochemical, they're significant payers of excise taxes, duties, and so forth. There are significant numbers of and types of chemicals that are being imported from China, subject to the regular rate of duty, in addition to the Section 301 punitive China tariff. So very popular form of tariff reduction strategy that's often implemented by chemical companies that are importing and exporting. So there's a variety of different duties and taxes and fees. I'm not going to go over each one of these that can be assessed at the time of importation. We'll hit the major highlights. Obviously, regular duties. So let's say that we have a particular petrochemical coming in. The regular rate of duty is 3.5%, and you also have a Section 301 tariff because the goods originate in China. So you'd be looking at an effective duty rate of 28.5%. Excise tax. There are certain products, tobacco, alcohol, refined petrochemical products that are subject to a federal excise tax. These excise taxes are available for refund via the drawback program. I will mention, however, that with this change of the drawback law, it can always be a double-edged sword because the government's able to rewrite the regulatory structure, and in some cases they, I would say, substitute their own will or their own policy agenda for that of Congress's. And their opportunity to do that is in the writing of the new rules or the regulatory structure. We've had a couple of court cases that have come out of the new regulatory structure. Specifically, the trade community disagreed with certain new regulatory provisions. And of course, one of our recourses is to take the government to court. Like I said, there was one significant case dealing with excise tax. We've now gone through the appeal process as well, and the trade community was victorious in that litigation. We have other fees that are collected at the time of importation: merchandise processing, harbor maintenance fees. Those are relatively small, well under 1%. I will point out that sometimes you have dumping duties, and these are punitive duties that are placed on products that are seen as being dumped in the United States or sold at either at or below their production costs. These type of punitive duties are not eligible for refund via the drawback program. Okay, I mentioned what we call these days TIFTIA. So in the area of trade compliance and in most specialized fields, you have its own nomenclature, language, many different acronyms. So TIFTIA, as it's called today, TIFTIA drawback would be referring to the modernized version of the drawback program that was implemented fully in 2018. Okay, and this resulted from it was a lengthy 10 or 12 year process that was a collaboration between the trade community and Customs and Border Protection, resulting in this supposedly new and improved drawback law. It was initially termed drawback simplification. I would say we missed the mark there. We probably replaced certain complexities with a new set of complexities. But once again, there were some important provisions of the program that were significantly liberalized, thus placing more refunds on the table. So let's get into the types of drawbacks that are available, or the categories of drawback that are available to the trade community. Starting with, once again, I'll refer to the drawback law here. United States Code Section 1313, Section J, deals with something that we call unused merchandise drawback. And this would be instances where a company is importing goods and they're exporting essentially in the same condition. Back in the old days, when I first started in this industry, this type of drawback was referred to as same condition drawback, because there were limited operations that were performed on the goods. You could test, clean, and repackage and so forth. Now we have an expanded list of operations that can be performed short of a manufacture process. So if goods are imported and exported without a significant value add, in most cases we're going to be filing them under the provisions of 1313J for unused merchandise drawback. Now, in order to really understand the drawback opportunity, it's important to make a distinction between the different filing methodologies. So unused merchandise is a type of drawback, and now let's take a deeper cut and talk about exactly how we go about matching imports and exports. There are two basic methodologies when it comes to matching exports and imports in a drawback environment. J1, once again referring to the law, is something called direct identification. In this instance, we would take an import and somehow match it or trace and link it to its subsequent exportation. Now that's typically accomplished using lot number, serial number matching. Okay, so we'll provide an example of that. An automobile has a VIN number. Typically, you're going to see that VIN number on both the imported invoice, the commercial invoice, as well as the export invoice. That VIN number is going to maintain the identity of the vehicle throughout the process when it's warehoused and inventoried in the United States and so forth. You also have other products that are serialized. In many instances, foods can be traced because of liability. I know titanium parts found in an airplane can be linked back to an ingot via a what's called a heat number. So there are certain industries where you could accomplish a direct link between the import and the export side. The alternative to direct identification is something called substitution. Now, instead of directly matching, which can be a bit of a painful process, you can imagine capturing both part numbers and serial numbers or lot numbers, and then tracing them through a company's enterprise management software. That could be a significant burden. So in most instances where the other methodology is available, something that we've referred to as substitution, we would take advantage of this substitution methodology. It allows us to match like merchandise. Well, how does one define like merchandise? This is a definition that's changed over the years as the substitution standard, for the most part, has been liberalized, culminating with the changes that occurred in 2016 with the signing of the TIFTIA legislation. Previous to the TIFTIA, we could match goods at the part number level, but without having to trace via lot number, serial number. So historically, the way substitution worked is you could export a pair of Ray-Ban sunglasses, let's say, and then we go back to the import side, and let's say there were 10,000 imports of the same pair of sunglasses over the previous months or years. We could select any importation of the same model number. Okay, so this substitution provision occurred at the part number or the model number level. With the passage of the TIFTIA legislation, we liberalized this substitution method so that now we can match at something called the harmonized tariff schedule number. So what does that mean in reality? Now we can export a pair of Ray-Ban 123 sunglasses and conceivably match them against an imported pair of Oakleys. Why? Because they share the same tariff number. They're categorized the same for customs purposes. Now, there are some important limitations on our ability to file under the substitution provision, and I'll touch upon a couple of those in a moment. But let's take a bit of a deeper cut at this substitution concept. And this is really where drawback becomes a bit more interesting and eye-opening, because in order to really understand your own company's drawback opportunity, one must thoroughly understand exactly how to apply the substitution method and really what it means in reality in terms of export activity that would be eligible to be included in your drawback claims. So let's start with a couple of real-life examples here. We work with some orange juice companies both on the West Coast and in Florida. If you look at a bottle of orange juice these days, you're going to see that the juice is being sourced from multiple locations. This is not yesteryear where a lot of the juice was coming from Florida and California that was being exported from the United States. For a variety of reasons, we've had a diversification of the supply chain when it comes to orange juice. In large part in Florida, we've had a disease called greening. So the crops are at historically low levels. In order to produce enough juice, we're seeing importations of juice from Mexico as an example, and it's coming in duty-free under the NAFTA agreement, what is now referred to as the USMCA agreement. The primary dutyable imports are coming in from Brazil. They're the largest global supplier of orange juice, and subject to a very significant rate of duty when it enters the United States. So let's say that we have an orange juice producer. We'll just throw a name out. This is not one of our clients, but everybody knows Tropicana. And Tropicana is importing Mexican juice. They saw some Florida juice. They're also importing from Brazil. We turn around and export juice that came in from Mexico, or in certain instances, we're exporting some Florida juice, different grades, by the way. Okay, let's say the juice doesn't meet exactly the same specifications. Under the current substitution provision, we can take all export activity. Doesn't matter where it was sourced. We could be re-exporting Mexican juice that came in duty-free. We could be exporting Florida juice, and we can match those exports against the imported duty-paid Brazilian activity, thus reclaiming the duty on the Brazil imports. Okay, so an important point here, the takeaway is the source of the export doesn't matter. As long as the import and the export meet the same harmonized or classified under the same harmonized tariff schedule number, they're considered substitutable for drawback purposes. Okay, another example here from our electronics industry. We import quite a bit of semiconductors in the United States that are used in a variety of production processes for goods that use chips from automobiles and appliances now, and of course computers and so forth. Many computer parts, high-tech components, historically have been imported at very low rates of duty. In the case of semiconductors coming in primarily from Asia, China is a major source of semiconductors, as is Japan, Malaysia, and so forth. They are free of duty until this major cataclysmic event called the imposition of Section 301 tariffs on $400 billion in imports from China, essentially now placed a 25% punitive tariff on semiconductors being imported from China. Now, this is a real-life example. Of course, we're not going to use company names because that would be divulging confidential information. But we have a client that we work with that is importing from different locations in Asia. Obviously, any chips that come in from Japan or Malaysia or Indonesia are free of duty. They're only paying the 25% tariff on the imports from China. Now let's take a look at the export side of the equation. They are re-exporting a certain percentage of their sales to locations throughout the world. A lot of these ships are repackaged, they're put on reels and so forth and re-exported. Now, under the old drawback regime, under the old drawback law prior to TIA, we were having to match imports and exports, even if we're filing substitution, at the part number level, right? So if this slice of this company's re-exports from the United States represents those items that were imported and from China and re-exported from the United States, it amounts to 100,000 pieces. Okay, the red slice of this pie chart. The vast majority of the chips that are being re-exported from the United States are sourced in Malaysia and Japan. Now, under the old drawback law, we would only be able to take this 100,000 and match it against the China imports because we'd have to match at the part number level. Under the new drawback regime, doesn't matter. The part number doesn't matter. All that matters is the fact that the exports and the imports share the same harmonized tariff schedule number. So now the entirety of the pie can be used to offset the China tariffs. That's a very, very important distinction there. In certain instances, depending on a company's business model, how they source the product and so forth, if they have multiple sources and origination points, including domestic and overseas, we can offset a large portion of their China tariffs, assuming they have sufficient export activity of the same harmonized tariff schedule number. Okay. So let's switch gears a little bit here. I talked about, to this point, we've been talking about unused merchandise drawback, where you import and export in the same condition. The other primary category of drawback is referred to as manufacturing drawback, different provision of the statute. As the name implies, you're importing raw materials and component parts, and you're producing a new and different article of commerce that is then exported. Under manufacturing drawback, we're going to be able to claim drawback. So if we're making an airplane component that ends up on a Boeing aircraft and it's being produced from imported titanium from China, once the component is exported as part of the finished aircraft, we could file a manufacturing drawback claim and reclaim the duty associated with the imported titanium. Okay, the assembly process or the manufacture process can be relatively simple. There doesn't have to be a certain amount of value added. That's really not the standard. You can import a boat and a motor and attach them. You now have a different article of commerce that has a different use that would qualify for manufacturing drawback. Okay, once again, I want to refer back to the substitution provision. Similarly to unused merchandise drawback, the substitution methodology is available in a manufacturing drawback environment. So let's take a look at a real life example here. We have exported PC that consists of a variety of different components. Power supplies, motherboards, CPUs, and so forth, cases, screws, nuts, and bolts. So let's take a look at the harmonized tariff schedule number for these components. As you see here, the GPU and the CPU share the same HTS, right? Different standard costs, because of course these are different item numbers. They're both sourced in China and they're subject to the Section 301 tariff. We now have a motherboard that's being sourced from a domestic supplier here in the United States. It shares the same harmonized tariff schedule number as the CPU and the GPU. We also have some memory that also shares the same HTS. The one component, motherboard, the two RAMs can also be used to offset the China imports. Why? Because the components share the same harmonized tariff schedule number as the imported components from China. So all components, regardless of whether they're sourced from the United States or whether they're sourced from a GSP country like Indonesia, I think Indonesia is still on the GSP list. Those will come into the United States duty-free. It doesn't matter the status, whether it's domestic or it's a duty-free import. All of that quantity can be used to offset the China tariffs. And this is really the beauty of HTS level substitution drawback. I will point out, however, there are some rules related to substitution. As you can imagine, we have differences in value. There can be, because it's a one-to-many relationship, we have many different part numbers that fall under the same HTS, each one of which has a different value. If you're exporting a Kia and importing a Mercedes, you only get the drawback associated with the Kia. So you have to take the lesser of the two values. And this really puts more of a premium on conducting analytics and using some pretty advanced software, which we'll discuss in a moment, in order to construct your drawback claims. For those of you that importing and exporting petrochemicals or certain chemicals, there's a special provision. The chemical industry passed their own industry-specific drawback provision. It's much more flexible. You can imagine if an industry writes its own law, it allows for harmonized tariff schedule level substitution at the 8th digit. We don't have to worry about values when we're matching imports and exports under this specific provision of the law, but it only applies to a very specific and distinct groups of what are called qualified articles. There's a list of harmonized tariff schedule numbers that are for chemicals that fall under this specific provision of the law. Okay, this should say probably NAFTA and USMCA at this point. The primary restriction, so NAFTA, now USMCA, was not drawback friendly. The primary restriction that it placed was on our ability to file under this substitution provision on exports to Canada and Mexico. So if you're importing and exporting goods in the same condition and you're filing under unused merchandise drawback, our only option is to file under the direct identification methodology. Okay. The other primary restriction on our ability to file under substitution deals with what I like to refer to as the other problem. I don't know how familiar my audience is with the harmonized tariff schedule. This is the book of classifications divided up into chapters that essentially represents any piece of merchandise that you can ever imagine. Anyhow, the classifications in certain instances provide you with a specific breakout or a product description. In other instances, we have catch-all baskets. These begin with the term other. So we could be dealing with a particular chemical that's manufactured that falls under the polyethylene, that's a specification, and if it doesn't fall into that specific classification or that description, it could fall into an other category. Okay. If we fall in an other category at the 8th digit, then we got to go to the 10th digit of the harmonized tariff schedule number. If at the 10th digit, we still don't have a product description or what's called a statistical breakout, and it just resides in this catch-all other basket, then we're not able to file under substitution. Our only option at that juncture is to go back to the part number level and file under direct ID. Now, this restriction only resides under unused merchandise drawback. This restriction does not apply to the category of manufacturing drawback. So you can see why I mentioned early in my commentary that the changes that occurred as part of the TIPTIA were not all necessarily positive and thus simplifying the process for claimants. And this would be a perfect example of an added complexity that really rendered certain claimants out there net loser from the legislative changes. And I'll give you a quick example of this, going back to an electronic component. These are unmounted chips, dice and wafers, high-tech components. So here we see the harmonized tariff schedule number. At the 8th digit, we have a breakout. So we qualify for drawback. We don't have to take it to the 10th because at the 8th, it doesn't begin with the other. If we move down here to 854129, 2900, it begins with other at the 8th. Now at the 10th, if your HTS has a breakout of 75 with an operating frequency under 30 megahertz, then we can claim substitution drawback at the 10th digit. But unfortunately, if you fall under 95 at the 10th digit, then we're in other, and our only option is to file under the direct identification provision of the law. The reason for this particular rule, Congress thought that allowing the substitution for goods that fall into these other basket was too broad in nature, and they wanted to place a restriction on it, and this was the compromise that was arrived at in order to essentially garner the support that was required to pass the legislation through Congress. So timeframes. This is an actual area where the recent legislative changes actually simplified drawback processing, in that there were multiple timeframes. I won't go into the particulars of the past because it really isn't relevant anymore. The big takeaway here is to understand that we have a look-back period or retroactivity. So in implementing a drawback program, if a company is looking at their full drawback opportunity, it's not just a matter of looking at it prospectively, because the law allows 5 years from the date of importation in order to file a drawback claim against that importation. So now we're looking at up to a 5-year look back. Now, you still have to have export activity that occurs after the import date, but the imports can be up to 5 years old. The only other point that I'd like to make here is, and this is another way of maybe taking a cut at the substitution provision of the law, and so you understand the full scope. Let's say that the Biden administration decides that the Section 301 tariffs are contributing to inflation, and so they want to roll those back, because essentially we placed a $100 billion tax on imports from China. Okay, certainly that had an impact on costs, as you know, any supply chain costs or product costs eventually are going to find their way into the cost of the finished article. So let's say they decide to roll back the Section 301 tariffs. So starting tomorrow or a month from now, goods that come in from China under the tariff classifications previously subject to 301 are now free. Well, the drawback law allows us to go 5 years back. Most companies are only exporting a portion of their sales. Very few companies import and re-export 100% of what they're importing from overseas. Normally, let's say it's something 20, 25, 30% is re-exported. Well, we can continue to use current export activity that came from China, but it was free of duty, free of Section 301, or it was back at the regular rate of duty, and use those exports to continue to feed off of the China imports from the past under the substitution provision. Because once again, all we have to do is match at the harmonized tariff schedule level. The duty paid or duty free status of the exported merchandise is not relevant. Now, eventually, you're either going to run out of time or run out of imports. But those Section 301 imports will continue to feed a drawback program well into the future, even if Section 301 goes away tomorrow. Okay, quick recap here, and then I'm going to speak to process. I was probably a bit overly ambitious with the number of slides that I have here, but depending on the number of questions, I may be able to cover a bit more ground during the Q&A also. So when we first speak with a potential claimant, a drawback claimant, we're approached all the time by companies that want to sort of investigate or review their drawback opportunities to determine if it's viable or worthwhile. Typically, we're looking at what I call three different buckets or three different categories of potential recovery. Bucket number one would be the easiest to understand, and that is drawback on a company's own import and export activity, drawback for their own account, where they control both the import and the exports. Bucket number two, we refer to as third-party drawback. Depending on your Incoterms, your terms of sale with both your customers and your vendors, it's certainly possible that there could be more than one company involved in the importation and the re-exportation of the merchandise. So it's very common, particularly in the steel industry, if you're buying imported steel from, let's say, Germany or Japan, normally there's a sales and logistics marketing arm for the German and Japanese mills that are located in the United States. They would clear customs and deliver the coiled steel, let's say, to your dock, delivered duty paid. Terms of sale would be DDP. In those instances, we can still claim drawback. We just need the cooperation of the importer. So here with this bucket number two, we can have multiple parties involved in both the import and the export of the merchandise. As long as they're all willing to cooperate, it takes two to tango, as they say. As long as both parties are willing to cooperate, we can still file drawback. But there's an existing organic relationship. Category number three is a bit more outside the box, but it's been legally vetted. And that is when we have an importer or an exporter that do not have an existing organic relationship. But let's say we have a chemical company on the import side that's importing xanthan gum from China, and we have a company on the export side that's exporting polydextrose. These are two separate chemicals that fall under different, what's called a chemical identification number or CAS number. But they both roll up to the same harmonized tariff schedule number. You can't sell your unused drawback credits on a secondary market. That's certainly not compliant. But you can utilize an outside third-party trading company to essentially build a bridge between the importer and the exporter of record, inserting themselves into the supply chain of each in order to, like I said, build a bridge between the importer and the exporter. And so long as we check all the applicable statutory and regulatory requirements, this type of drawback trading arrangement, as we term it, was affirmed by customs headquarters via ruling request. So anytime that we in the industry are pushing the envelope a bit, or there's a point of potential disagreement, or it's uncharted waters, you can submit a ruling request to Customs and Border Protection in Washington, D.C., and attorneys that work for Customs and Border Protection that would then issue a decision. So this type of drawback trading arrangement was confirmed via a favorable ruling back in 2003. Very few companies, in my estimation, can really take advantage of this. It's the further you move up the manufacturing food chain, the classifications become more specific. Trading is most appropriate for base commodities, traditional definition, orange juice, chemicals, steel, commodities. So let's talk process with some of the remaining time that we have here. So that was a quick and hopefully not too boring. I hope everybody had their espresso this afternoon, but that was your tour of Drawback's regulatory structure. Let's talk process now. So here's the basic takeaway. Not all drawback programs are worthwhile. There's a significant amount of drawback recovery that remains on the table each year. Some of it simply because the company is not aware of the opportunity. You can imagine the regulatory structure can be somewhat daunting. I can tell you right now, providers like Alliance in the industry are being very selective. Everybody has limited resources. Unlike accounting services where we can go out on the street and hire numerous people that have, they're CPAs or have booking experience. Drawback is so highly specialized. In the normal course of events, we have to train people and build them from the ground up. So there are limitations on our ability to properly administer programs and provide adequate service levels. So companies generally right now, given that we have this deluge of business that was caused by Section 301, companies are being very selective. So, we're spending a lot more time during this assessment phase of the process to make sure a program is viable. So what are some of the variables that we take into account? First and foremost, how much money is on the table? Everybody wants to know what's the recovery potential. I mean, back when I first started in Drawback more years ago than I care to admit, we take a really hard look at any program that had less than $100,000 or $150,000 a year in annual base recovery, and they needed to have $300,000 or $400,000 going back in time. Section 301 has changed that calculation. The bar is much higher in my estimation, and then there are other variables that we want to take into account. Not all programs are created equally. We have incredibly complex programs in the electronics industry, as an example, where our clients are having to file under these direct identification provisions for one reason or another. They have millions of lines of data. The compliance burden is significantly greater for those type of direct identification, or if you remember, J1 programs under unused. And so consequently, the recovery bar is higher. So it's a matter of balancing what's the recovery level, the administrative resources that are going to be required, and then what is the regulatory compliance exposure, because there's always a certain amount of compliance liability with any type of customs transaction, be it a regular import entry, a drawback transaction, a foreign trade zone transaction. So to use more common vernacular, is the juice worth the squeeze? That's the question that we're asking at this phase of the process. And so we look under the hood, run some of the numbers, look at ACE reporting, see if we can at least conduct a high level of assessment. And if we need to, then dive at deeper levels to further qualify the program and simply make sure that the program is minimally viable. What's the number look like today? Well, I mean, once again, if you're filing under the substitution provision, typically that can be fully automated. And so a lower level of recovery may be more viable depending on what statutory provision that you're filing under. Certainly the availability of record retention is important as well. We submit claims to customs electronically. They're subject to customs review. We rarely see full-blown audits. They're normally conducting spot checks or what are called desk reviews. And typically companies get caught up on, for example, proof of exportation. So during this assessment period, we're going to ask questions related to a company's record retention. Do you control your export transactions? Are you delivering to Miami? And then at that point, your customer, the ultimate consignee overseas, based on your terms of sale, would control the transaction. So there can be different buckets of risk on the export side, depending on your terms of sale. This is all part and parcel of the initial validation or qualification program of the potential program to make sure that there's enough recovery on the table and that we can withstand any type of customs review. So the bottom line is we want to maximize recovery, but always do so with the least amount of regulatory compliance exposure. Okay, so let's make a determination. Let's say we make a determination that the juice is worth the squeeze. We have a potential claimant, they have $1 million a year. I mean, we have claimants right now with Section 301 that are claiming into the tens of millions of dollars per year. And they're looking at, retroactive refunds back to when they started paying the China tariffs in 2018. So we make a determination that we want to proceed. What's the next step in the process? Generally, you sit down and you organize the program, conduct implementation meetings, At that point, we outline the various steps that are required to establish a program with Customs and Border Protection. There are certain applications that we seek during the initial stages. So there's a startup process with Customs as well to establish a claimant's drawback program. One of the primary applications is something called accelerated payment. Everybody, and this is a filing privilege. You apply for accelerated payment privilege. It could take Customs 120 days to respond to you. Once you're approved, our drawback claims, we're going to receive a treasury check or an electronic payment within about 30 days from the date of filing. All of our accounts are filing under the provisions of accelerated payment. If you're claiming manufacturing drawback, there's something called a manufacturing ruling that would need to be secured. Typically, we're applying for all these filing privileges or ruling requests are all part of the process of managing and organizing a drawback program. So with that, let me take a breath. I know at this point we're supposed to open it up for specific questions. Do we have any questions or comments at this juncture?
All right, thank you, sir. So yeah, we're open for questions right now. For those attendees, please feel free to type in your question on the comment section part of the screen.
Okay. While we're waiting for some questions, I'm going to continue because we do have a bit more time here, correct?
Yes, 14 minutes more.
Okay. Well, questions are being formulated. Let's continue to a couple more slides here. So, as a 10,000-foot view, constructing a drawback claim is a function of gathering certain data elements related to the import and export activity and validating data integrity. There are a variety of tests that we run on data. In certain instances, we can't fully automate the process, so we might be grabbing import documents and keying the required data elements manually. That is sometimes the case, particularly if we're having to delve down into the part number level, because part number level detail is not always available, either through the customs broker or through the ACE portal. ACE is customs system. That's their enterprise management software for the processing of imports and exports in the United States. ACE doesn't operate at the part number level. It operates at the classification level. So if we're filing under direct ID, for example, ACE is not going to give us the level of detail that's required. So we may have to grab documents. The bottom line is we're grabbing all these required data elements, whether we're doing so electronically in an automated environment or having to manually key the elements. Ultimately, what do we do with all these data elements? We're going to place them or load them into the equivalent of TurboTax for drawback. So we maintain our own proprietary drawback software that processes a drawback claim. We also develop all kinds of routines to test data, validate its integrity, adjust data if needed. Once it's all dialed in, it's then going to be uploaded into the software application that conducts all the matching that we discussed, and it has all of the functionality necessary to properly match imports and exports, depending on whether you're filing under direct ID, substitution. Now, if you're filing under manufacturing, in addition to import and export activity, you're also going to need to capture bills of material, which relates the imported component part to the exported finished product. Okay, so that's going to, and we're going to include all kinds of fields. The bill of materials, what builds the bridge, once again, between the import and the export side of the equation in a manufacturing drawback environment. Okay, this is just a quick overview of the source. Now, I've just alluded to some of this information, and that is specifically, where do we grab the data? If we're able to automate parts of this process, what are the sources? So if we're filing HTS level substitution, U.S. Customs allows us to grab import data using their Automated Commercial Environment, or ACE as it's referred to for short. That's the acronym. And so if we're filing under J2, which is unused merchandise substitution, we can grab the data that we require from ACE. If we're filing under the direct identification provisions, that involves us capturing line item detail. In many instances, certain cases, the customs broker on the import side, but if I had a dollar for every time a customs broker said we have accurate line item detail, be a rich man, because in many instances, once we really test the data, we find out there's data integrity issues. So in many instances, we're having to capture or manually key the data elements from the actual documents, the import documents themselves. The export side of the equation, generally, if a company is utilizing SAP or Oracle, all the fields that we require to populate our export database within our drawback processing software would reside in a company's enterprise management software. So we can automate the export side of this equation. However, I will caution you, in many instances, we run into data integrity issues on the export side. I've seen it all over the years, where erroneously we have movements that are foreign to foreign, where a company ships from, let's say, Japan to Europe, and inadvertently that's captured as an export. Only activity that originates in the United States and is exported from the commerce of the United States compliantly qualifies for drawback. You also have canceled orders, short ships. And so in many instances, we have to conduct extensive validation, and in certain instances also perform some extensive janitorial work. And then we always want to test against hard copy export documents to make sure our record retention systems are robust enough on the export side to withstand a customs review. Okay, we're quickly running out of time. I'm going to spend the last couple minutes here focused on, I mentioned to you that we file claims electronically, so not unlike tax returns where, individual filers are submitting, electronic summaries of forms and so forth, and then the IRS would come back and audit you or ask for substantiating documents. Similarly, when we submit a drawback claim, we're doing so electronically. We're not actually submitting any of the supporting records or documentation. So we need to make sure that records are being maintained for at least 3 years from what's called the liquidation of the drawback claim. So when we file a drawback claim, as far as we're looking at the life of a drawback claim, it's born the moment that it's accepted by Customs and Border Protection. Within that ACE system, there's a module specifically for the submission of drawback claims. That's where drawback claims are processed by Customs and Border Protection. So we're going to have a filing or an entry date, thus begins the life of a drawback claim. If we're filing under accelerated payment, that claim is going to be paid within approximately 30 days we receive a treasury check. Now the question is, how long do you have to maintain the records and make them available to Customs? Well, there's something called the liquidation of the drawback claim. That's when Customs actually gets around to reviewing it. In certain instances, these claims, even if they're not reviewed, would, by matter of law, liquidate, which is sort of the final disposition of the claim. That assumes that the claim isn't protested. Customs can voluntarily reliquidate the claim, but it's sort of the beginning of the end, let's say that. So we have to maintain all the supporting records, but in a normal course of events, the claim is going to liquidate approximately a year after it's filed. We then have to maintain records for another 3 years after that point. What type of records we're looking at? On the import side, now some of these records are, I would say, marginally useful, and I sometimes push back against customs if they're, asking for purchase orders. They don't really accomplish a lot in a drawback environment, but they may ask to see them. Purchase orders in many cases these days are, could just be an email. The Customs Form 7501, that's an important document. That's the customs entry document that's associated with imports in the United States. Import bill of lading, marginally useful. The commercial import invoice is very important to the drawback process. That's where we're going to see part numbers, values, and so forth. Packing list, marginally important. The export side of the equation is normally where we run into issues. Generally, import records are readily available in the claimant's own record retention. We can go to the broker on the import side. Sometimes you have to pay a fee, but generally not too hard to get your hands on the import documents. On the export side of the equation, we're relying on the drawback claimants, the record retention system, and that can be a mixed bag. The bill of lading, now we're not talking about the bill of lading from the warehouse or to the port. We're talking about the export bill of lading. So that would be the ocean bill of lading or the airway bill of lading that shows a foreign destination and origination point in the United States. Okay, if it's an ocean export, it needs to have the laden on board date. Sales invoice or commercial invoice on the export side of the equation is an important document. Packing list, not so much. Proof of delivery comes into play if we're talking about courier transactions. We're talking, FedEx, the courier side, DHL, and so forth. We can utilize some of their reporting to further substantiate the movement via courier transaction, because FedEx, they tend to purge their system. You can't perform a trace on it 2 years after the fact in many instances.
Yes, sir. I'm sorry to interrupt. We still
Please.
have 2 minutes left. Can you answer the questions before we run out of time? We have questions here on the comment section.
Yeah, that'd be great.
Can you see it?
I am not seeing, hold on, let me check.
It's fine. So the first question is, how long does it take to receive refunds? And second question is, how do drawback companies charge for services?
Okay, great question. So let's say we're initiating a brand new program. There's a startup process with Customs and Border Protection. We're submitting requests for accelerated payment privilege. If it's a manufacturing program, let's just count on somewhere between day one startup, the implementation, and receiving your first check in hand for your retroactive refund is going to be somewhere between 4 and 6 months. A lot of variables in the mix. How complex is the program? How much can we automate? Okay, these are some of the variables. Let's say that we bring the program current. We filed all the retroactive refunds for the past 5 years. We're now in continuous operations mode. So the program's been set up with Customs. You're approved for accelerated payment privilege. We filed all the past, and now we're moving forward on prospective filings or current filings. Normally, we're going to be filing on a quarterly basis for our accounts, our clients, and they're going to get paid within about 30 days from the date of filing. Okay? How do drawback companies charge? The vast majority, Alliance and our competitors, operate on a percentage of the recovery. That can vary dramatically. 10% is probably a good starting point, but with Section 301, that was once again the proverbial game changer. We have claimants that are filing, in excess of 5-6 million a year. The higher the recovery, the lower the fee structure. So once again, it's going to vary based on administrative resources required, the size of the program, the complexity of the program.
All right, thank you. So you already run out of time. So before we end the webinar today, I would like to ask the speaker to say his final words regarding the presentation. And by the way, guys, this recording, this is actually recorded. It's will be posted on our YouTube channel. And yes, if you would like to reach out more about the presentation and have more questions, the email address is here. Maybe, sir, you can type in your email address on the comment section so that they can just copy it.
Okay, great. And then it's on the screen here as well.
Yeah, you can stop sharing and then just type in your, all right, there you go. So Jed already put your email address here. You can feel free to copy the email address, and if you have any question, please let him just email him. So before we end, any final words, sir, about your presentation?
Yeah, I'd just like to thank the audience members for tuning in, for participating today. Thank you to your organization for hosting and sponsoring the event. The long and the short of it is, we're very objective about assessing the viability of the program, given that we operate on a percentage of the recovery. If you have follow-up questions or want us to work with you in determining whether you have the basis for a substantial program, we're happy to work with you in conducting a detailed assessment. And with that, I will sign off.
All right. Thank you so much for that very interesting and presentation, sir. Thank you guys for attending today, and we hope to see you guys in the next webinar. Thank you and have a good day.
Ron, appreciate it. Thank you for moderating.
No worries. Bye-bye.
Take care. Bye.